Good evening, or good morning, good afternoon, and good evening. My name is Hazel Bateman. I'm president of IPRA, and I'd like to welcome you to the second IPRA webinar for 2023. Before we begin, in Australia, where I'm based, it's customary to show our respects to the traditional custodians of the land. And so I'd like to show my respects and acknowledge the Dharawal people, who are the traditional owners and custodians of the land on which I'm currently located. So I would like to introduce you to today's speaker. So today's speaker is Moshe Milevsky. As many of us know, he's a tenured professor at York University. He has broad research interests at the intersection of pensions and retirement, actuarial mathematics, and the history of financial products. And the presentation he's going to give us today actually covers all of those bases. So Moshe will speak on Adam Smith's reversionary annuity, money's worth, default options, and auto-enrolments. Moshe will speak for around 30-35 minutes, and then we'll have plenty of time for questions and discussion. And in the questions and discussion, please use the raise hand or put a question in the chat, and I will facilitate questions to Moshe. So Moshe, the floor is yours.
Well, hello, everyone. Good morning to all of you on the East Coast of the US, and good evening to all of you in Australia and everyone in between. As you heard from Hazel, my name is Moshe Milevsky. I am a professor at York University in Toronto, and the presentation that I'm going to be sharing with you today is called Adam Smith's Reversionary Annuity, Money's Worth, Default Options, and Auto-Enrollment. And the painting that you see on your right is an image of Adam Smith that is stored in the National Galleries of Scotland. My presentation today is almost entirely history. It's about the past. My data is hundreds of years old. And usually when an academic shares data that is old or stale, they have to explain why their data is so out of date. And in my case, it's hundreds of years. So what I'd like to do a bit is to motivate this history. Anytime you speak about history or you give a presentation about history, the question is, how is this relevant today? Why should I care about something that happened in the distant past or in a foreign country so long ago? So before I start with my official remarks, I'm going to give you 3 or 4 reasons as to why you might want to pay attention to an event and to events that took place so long ago. I'm going to talk about a fund that was put together in the 18th century. Why should this be of interest today? So the first reason to be interested in what I'm going to talk about is that we are now sitting at the 300-year anniversary of Adam Smith's birth. The tercentenary week was last month in University of Glasgow and many other places. He was born in 1723, which is exactly 300 years ago. And his birth date isn't just some random number. It's going to become relevant when we talk about some of the actuarial details of an annuity plan in which he participated. So reason number 1 to pay attention, Adam Smith is trending now. This is the 300 years since his birth. Number 2, as to why people might want to pay attention to this if you're on the US side, Secure 2.0, which is this very big piece of legislation that's passed, second version passed at the end of last year, introduced an easier pathway for sponsors to put annuities into those plans. And in fact, there's now a discussion about whether annuities should be default investments in a 401k. And by default, I mean that if the client or the participant saver does nothing, they're going to be put into an annuity. And there's a lot of consternation around that. Should it be a default? Should be defaulting people into annuities? And the plan that I'm going to talk to you about that is 300 years old defaulted people into an annuity. So maybe there's something to learn from that. Third reason to pay attention is for those of you that are in the UK, the plan put together by Hunt is to, and I'm going to summarize this very briefly, to have defaults in defined contribution plans allocate at least 5% to untraded equity, non-traded equity, and there's consternation around that as well. Should we be defaulting people into something like this? Will it improve outcomes? Are the fees going to be too high? And of course, as anybody knows in this business, you can always opt out of a default. So if people are unhappy with this, they can just opt out. But the issue here is the inertia, and a lot of people are going to default and not going to change their behavior. So that's a third motivation. Fourth and final one for the academics here. There's a very famous paper that was written and cited thousands of times. It's at least 20 years old, by Bridget Madrian and Dennis Shea. And they talk about, they're one of the first papers to talk about 401k plan behavior with default options. And I'm quoting directly from their paper. They claim that a substantial fraction of employees hired under automatic enrollment retain the default contribution. They just default and they stay there. The inertia is very powerful. And they claim that the passive behavior is sometimes viewed as a recommendation. Well, if the employer said that this is what we should be doing as the default, that's investment advice. I'm going to show you data from, again, a 300-year-old plan, and I'm going to have data on defaults. There were defaults and choices that people make, and we're going to see whether this observation that people tend to default and stay in the default and not opt out, whether we saw that hundreds of years ago. So those are the four motivations. So now let me get to the subject at hand. In 1744, the Church of Scotland launched a very innovative scheme, and they used the word scheme, not me. It has pejorative connotations nowadays. They called it a scheme, and this is how this worked. It provided ministers in the Church of Scotland and university professors who petitioned to join this plan the ability to purchase reversionary annuities, and I'll explain them in a minute, which is a type of pension for their wives and children. This is known as the 1744 Fund for Widows and Orphans. Some of you may have heard of it already. But what many of you may not know, if you did hear of this plan, is that participants had some very interesting choices that they had to make. There was choice architecture, and that's what I'd like to talk about today. Adam Smith was one of the many participants in this plan by virtue of the fact that he was a professor at the University of Glasgow, and in the 1750s, or 1751 to be precise, when he joined, he was defaulted, or he had to make an investment decision within this plan, and I'm going to talk about that. He was 28 when he joined as a professor at the University of Glasgow. This is before he wrote The Theory of Moral Sentiments. That's where he wrote it, and certainly before he wrote The Wealth of Nations. His age isn't just a factoid of interest to antiquarians. His age is going to become very important from an actuarial and an insurance point of view. For those of you that have heard about this, one of the well-publicized discussions of it was in Niall Ferguson's book, The Ascent of Money. He has two or three pages on this scheme. He did not talk at all about the choice architecture. He got a couple of details wrong, and he certainly didn't talk about the fact that Adam Smith and a number of other very well-known literati were members of this. While on the subject of history, this isn't a formal literature review, but if you're really interested in this, if you hear me and you say, wow, I really want to learn a lot more about this, you couldn't do worse than starting with C.G. Lewin's book on the history of pensions and insurance before 1800. He also talks about the plan in a couple of pages, but again, the choice architecture, which is what I believe is my contribution here, wasn't discussed. So here's what my plan is for the remaining 20 or 25 minutes. I'll obviously keep it to within the time limit. I would like to explain this scheme in financial economic terms. How exactly did this scheme work? Then I'd like to analyze Adam Smith's investment. I mean, he participated in this. What was his internal rate of return or something of that sort? And finally, I'm going to talk a little bit about the archival data and the choices that were made by participants in this plan. I spent some time in the archives at the National Records of Scotland, and I'd like to show you some of those as well. So let me get started. So for those of you, and I'm sure based on the list of illustrious names that I saw joining the screen earlier, I don't have to tell you what an annuity is, but for those of you that aren't intimately familiar with the details of an annuity, a traditional annuity is an immediate annuity where you pay a premium, that's the red arrow going down, and in exchange you immediately get payments for the rest of your life as long as you live. Those are the green arrows. That's an immediate annuity. An immediate annuity then has a close cousin called a deferred annuity, sometimes called a QLAC or an ALDA. That's where you're paying a premium right now, and the payments, the green arrows, start at some fixed deterministic known time in the future, say age 85. And of course, the premiums don't have to be paid upfront in one lump sum. You could pay it slowly over time. That's a deferred annuity. Very well. Then you have a contingent annuity, and a contingent annuity, you'll notice, is you're paying periodic premiums, but it's going to be until a point in time that is exogenous to the lifespan of the individuals. Think of it as a market crash. So as soon as the market crashes, somebody will start receiving payments, and those payments will continue for the rest of their lives when an account hits zero. So if any of you own variable annuities with guaranteed life withdrawal benefits, or GMIBs as they're called in North America, that would be an example of a contingent annuity, stochastic time market crash. The fourth and final one, and the focus of today's presentation, is a reversionary annuity. In a reversionary annuity, once again, you're making periodic premiums, but the income is going to start at a stochastic time, which is your time of death. It's not going to go to you, it's going to go to someone else. And most of the time, this would be going to a spouse, which is why the green arrows are on an angle. You make the premiums until you die, and then at the time of death, this is going to go to a spouse, and it'll continue for the rest of her life. It's a type of life insurance, except that instead of there being a lump sum that's going to go to the widow is going to receive payments for the rest of her lives. And already hundreds of years ago, the designers of the scheme I'm about to talk about said, it's probably more efficient to give widows periodic premiums and payments for the rest of their lives than giving them a lump sum, because that way they don't have to figure out how to invest it. They were extraordinarily popular as a way for provisioning for widows. The key actuarial question, and I don't have time to delve into this too much, is what is the appropriate multiple? If you're making periodic premiums of $1 or £1, what should the multiple be that the spouse or the widow receives for the rest of her life at this time of death? What should that multiple be? Should it be 2 to 1? Should it be 4 to 1, 6 to 1, 8 to 1, right? Somebody's paying a premium. What should that multiple be? And this was something that was examined and analyzed from an actuarial perspective in the 18th century, and the matter was considered closed. By the end of the 18th century, pretty much actuaries, or what we would today call actuaries, had a good sense of how to value this, what the multiple should be, given mortality and interest rates. But even in today's day and age, there's still analysis of this. In fact, one of the first modern papers on computing the distribution of the present value and the variance of what is called the widow's pension was actually done by Phelim Boyle in 1974. One of his earliest papers was on valuing or pricing this thing. So I'm going to return, assuming I have time, to the actuarial minutia of what that multiple M should be. But what I'd like to do now is talk about the choice architecture for those of you here that are interested in what was this plan like. So let's delve into it. So the data that I'm about to show you comes from the National Records of Scotland. They have a historical search room. You contact them in advance and you say, I'd like to see the records of this fund. There are hundreds, literally hundreds of documents that pertain to this period. They used to be at the Church of Scotland because they were the ones running it. It was then moved to the National Records of Scotland. And this all started in March of 1744. Effective the 25th of March of 1744, an act is passed that mandated, this was mandated, Act of Parliament, that participants they were defaulted into this scheme, and they had no choice if they became employees after 1744. You have no choice. You got to participate in the scheme, and it's just a question of the level at which you're going to participate. Every single year, the trustees would have to put together a report on the activities of this fund over the last year. What choices did people make? What are some of the difficulties that we're having? Asset allocation decisions. Yes, asset allocation. They didn't call it asset allocation, but where are we investing this? Are we investing this in banknotes? Are we investing this in fixed income securities? The trustee report of 1752 lists, among other things, all the people that joined the plan this year, and one of them was Adam Smith, who had just joined in Glasgow. So let's talk about the choice architecture. What were the options that were available? So let me get started. The first contribution class, think of it as 4 different funds that you can choose from, although they weren't funds in the modern sense of the word. The first was as follows. you could contribute £2, 12 shillings expense, which decimalized would be 2.6, and that would entitle to your widow a reversionary annuity of £10. The multiple was 3.81. So you put in 1 or the 2.12, your widow would receive a payout multiple of 3.81, and this was independent of age. There was a second that you could choose. You could choose which one you wanted. Contribution class number 2. You could put in £3, 18 shilling, 19 pence, 3.9 decimalized. What would your widow get? Obviously, she should be getting more, £15. Do the math, the payout multiple is going to be exactly the same, 3.81. So the payout multiple was always the 3.81, and it was just a question of how much you wanted to contribute. You want your widow to receive a small annuity when you pass away, it's going to be £10 annuity, you're going to pay 2.12. You want her to get the largest one, it would be 25, and that would cost you 6, 11, and 3. So what were some of the decisions that people made? What were some of the choices that people had? Well, they could decide which one of the 4 they could participate in. They could opt out entirely if they had joined the plan prior to 1744. And also there was a default. So let me talk about all of those things. But one thing is very important for people to understand. The plan was age neutral. It was non-discriminatory, and it did not depend on either the age of the contributor or the age of the spouse. There are clearly winners and losers. If this was a class and I was teaching actuarial science, I'd ask the students, so who do you think gains and who loses and who's getting the better deal when this is age neutral and who's getting the worst deal? There are winners and losers. Now, there are a lot of minutia details that I don't have time to go through that are actually quite fascinating. For example, the reversionary annuity would terminate upon remarriage. So the widow would receive that income, but if she did remarry, it would stop. And that was obviously a disincentive for people to actually get married again, widows to get married, because they're going to lose their annuity. And this is something we observe historically. I think Laura Salisbury has done some work on Civil War pensions that had the same effect. But in many cases, widows would not disclose that they had remarried so that they can continue to receive the pension. And this, of course, would all show up in the annual reports. So now let's delve into choice architecture. Was everyone required to participate? Was there an opt-out? And what was the default? And then I'll show you what was some of the decisions that people made. So here's the schematic of scheme choices. We're going to dig a little bit deeper. We're rolling up our sleeves here. So it depends on when the professor or the minister joined the plan. Now, some of you sitting here in the 21st century are wondering, why are professors and ministers together in the same scheme? But there were very close contact between them, especially during the Scottish Enlightenment. And it wasn't uncommon at the time. And what really happened was the ministers set up the plan. The professor said, hey, we like it. Can we join it as well? So here we go. If you joined prior to March 1744, what does that mean? You were a professor prior to March 1744. You were a minister in the Church of Scotland prior to March 1744. You were defaulted into category number 2. So if we didn't hear from you, if you didn't send in a notice, you were put into category number 2. That was the default option. That was the passive option. If you didn't like the default, you could choose any one of the 4 categories, including the default. So some people wrote in and said, I want the default. Others said, no, I do not want the default. Share data in a moment. And finally, you can actively opt out. You could send in a notice that said, I am not interested in participating in this scheme. But if we didn't hear from them, they were opted into category 2. What if you joined after March of 1744, after the law passed? Then you had no choice. You were defaulted into category 2. You could send in a notice and say, I would like one of the other ones, but you did not have the option to opt out. You couldn't opt out. And for those of you that are following the math here, Adam Smith joins in 1751 or 1752. He couldn't opt out. So the only thing Smith can do, and many others, by the way, there are hundreds of participants. It's not just Adam Smith. They can say, look, I want to have the lowest contribution rate. I don't like this plan. I want to go in the lowest contribution rate or the highest contribution rate. For those of you who are wondering, the micromanagement of this, and to be honest, this is what impressed me the most, not the actuarial multiple of 3.81. How do you manage a plan like this in the 18th century? So you had to send in a notice, and the notice would look like this. Adam Smith would have had to send in and fill in the blanks. So they were given a sheet of paper that was printed, and they'd have to fill in what's the level at which they want to participate. Being mindful of the time here, one of the many questions that comes up here, was this a meaningful sum of money? £2, £4, £6 over the course of a year, and they were made in annual payments. I mean, is this a meaningful sum of money? How does one figure out if this is meaningful to a minister? So I was able to get some data on benefices and wages in the 1750s. There's records at the Church of Scotland, and you can actually take a look at the distribution of what wages were, because I wanted to see, was this a reasonable sum of money? And this is the distribution of wages. There were anywhere from £20 to £140 per year. And what the frequency is, there was a legal minimum. Ministers had to be paid a legal minimum of £42 per year, although in some cases they were violated. If you take a look at the average, you go to the 50% mark, it's about £55. The point is, this was material. These were not trivial sums. If I were to convert it into modern day contribution rates, it was about 2%, maybe as high as 15% of typical wages. This was a substantial sum of money that people had to contribute. And in many cases, default, right? I mean, if you do nothing, they're going to take that out. So what do the archival records look like? I've got about 10 or 15 minutes to go. What do the archival records look like? So here we go. This is where it gets interesting. This would be filled out with information about the choices that people made. There's a lot going on here on the page. I can't go through all of it, but I will focus your attentions. If you can see the red boxes, that is Adam Smith right there. He's listed twice. I'll explain why in a moment. The columns that you see are the years, whether he was a member of the plan or not. He's obviously not until 1751. Then it shows whether he's a bachelor or married. I'm going to come back to this later. He's a bachelor during the first few years. It shows the year at which he joined. And here we go. At what level did he contribute? 1, 2, 3, or 4? What level did he pick? And Adam Smith picks the highest possible rate. Highest rate, 6, 11, and 3. He wants the highest possible rate. For those of you that are wondering why is his name twice in the records, he joined as a professor of philosophy, and then he moved to moral philosophy. Some say it was logic. He moved. When he moved, they had to change his entry. But there we go. He selects the highest possible rate. Who else is in this scheme? I keep on talking about Adam Smith. Well, for those of you that are Scottish, you will know this already. Colin Maclaurin, the famous mathematician, was a person who actually was involved in setting up the scheme. Don't want to get into too much of the details. He helped select the, or he helped sort of price this. He came up with the 3.8 multiple. He was involved in that. He used Edmund Halley's mortality tables. I could spend an hour just talking about that. What did he pick? He did not pick the highest rate. He actively selected the second highest rate. He went to the third category. Some say because he was financially constrained. And when I say some say, he was known to be financially constrained. He didn't pick the highest rate. He picks the third category. Colin Maclaurin, of course, is buried in Greyfriars Cemetery. Again, for those of you that are in Scotland, you know this, you've heard of this. If you ever visit Edinburgh, go take a look at where Colin Maclaurin, the mathematician, is actually buried. One last name, and then we'll move on. Alexander Webster, the minister who was the co-designer and the architect of the scheme, he selected the highest possible level. And he wrote this, and this is what I found interesting. He was trying to justify, why not just give an insurance payout to the widow, like in modern days? You know, here's $1 million, do what you want with it. And he said the committee cannot help thinking that £20 payable yearly to the mother will better answer the purposes than one lump sum of £200. And he actually talks about smoothing consumption that way. He obviously doesn't use the word smoothing, and he doesn't use consumption. They certainly didn't use the word nudge. But when you read the correspondence, it's very clear they felt that giving people a stable income for the rest of their life was much, much better than giving them a lump sum. It's just unbelievable when you compare it to discussions today in a 401k plan in the US. Should we give people a lump sum at retirement, or should we give them smooth income for the rest of their life? And there you go. Alexander Webster, the minister, almost 300 years ago, says, give them income for the rest of their lives. All right, now let's get into the minutia of this. What did people select, right? So we have, you know, Adam Smith, the highest, and Colin Maclaurin, the second. What did people select? Was it expected? So here we go. When the scheme was set up, the scheme designers predicted what people would pick. They had to predict this. They had to forecast this because they were trying to figure out what the fund would look like over time. They were trying to forecast how big the fund would be. You need to predict what people are going to select. So this is the assumptions that were made in the 1740s. The plan designers said that 21% will select class 1. They said 54%, the majority, will just default. Maybe they had read Madrian and Shea. Well, again, this is the 1740s. Class 3, 21%, and they said class 4, nah, nobody's going to pick that class. It's a big percentage of someone's benefits. They're not going to put in. Opting out, nah, nobody's going to opt out. That adds up to 100%. That was what they assumed, and they needed these assumptions in order to do some sort of funding. What did people actually select? For those of you that are just waking up, this is where I would spend 15 seconds paying attention. What did people select? And the answer is, this is what happened when the dust settles a year in. Class 1, very few people selected class 1. Class 1, that was not selected. Much less than what people had assumed, much less. Class 2, the default. No. 21%. In fact, they broke it down. Only 12% defaulted, and 8% said, yeah, I'm going to go into the second class. Even though had they said nothing, they would have still been in the second class. They didn't like that. They didn't like the default. They opted out. Class 3, 33%, more than what had been predicted. What really got the vast majority? 26% class 4 versus the 3.2 predicted. Opted out? Yeah, we got some of those as well. 15% opted out. And of course, that's going to give you the 100%. I find it interesting, the people that opted out, again, this is, the minutiae of the Scottish Enlightenment. Francis Hutcheson may not mean anything, but he was Adam Smith's professor at Glasgow, very famous philosopher. He opted out. He sent in a letter, I do not want to be part of this scheme. Very interesting because his writing is always about ethics and morals. He does not want to be part of this scheme. Another very, again, famous in Scotland, Robert Simpson. He was a professor of mathematics. He actually taught Colin Maclaurin. He sends in a letter, I do not want to be part of the scheme. He's a math professor. What did he know? Some people think that this was a function of older people selecting the highest rates. I don't want to spend too much time on this, given that I have 5 or 10 minutes to go. It wasn't older people selecting the higher rates. This is some of the discussion that has taken place about this fund over the years. When I actually tabulate this by age, so let's take a look at the 28 to 33 bin. 57 are married, 103 are not married. They selected about a 17-pound annuity. This is for the spouse. As you go down to higher ages, you don't necessarily see a higher trend where older people are selecting more. It's just a lot of people said, I like this deal. I'm going to invest in the higher amount, as opposed to older people doing that. This isn't just, a statement that's anecdotal. When you actually run a regression, if you can call it a regression on the small number of data points, yes, married people selected higher annuities than unmarried people. Kind of makes sense. They're married. There's a widow there potentially, or maybe their spouse said, hey, you should join this plan. But the trend is negative as a function of age. So I don't think it's older people selecting the higher rates. So what's the research conclusion? Madrian and Shea claim that a substantial fraction of employees under automatic enrollment retain the default contribution and fund allocation. This didn't happen in 1744. And it really surprised the designers of this scheme to the point where a couple of years in, they're saying, wow, we did not anticipate this. We have to pay much higher benefits now, because obviously if people are going into the higher classes, when individuals start to die, they have to pay higher amounts. In the last 5 minutes that we have together, 5 or 10 minutes, was this fairly priced for Adam Smith? Let's delve into the actuarial details. Remember, the multiple is 3.81. He's putting in 1 to get 3.8, or he was putting in six pounds in order to get the 25. Was this fair? So how does somebody do this? So, for a couple of minutes, I'm going to get geeky here and do some actuarial mathematics. I'm going to value this, and I'm going to value it under a Gompertz law of mortality. And I need a distribution for the population, and I want to get some sort of analytic expression for the reversionary annuity. So I'm going to use a smooth curve for the distribution of deaths that I'm going to fit to Haley's mortality table. And yes, I know Gompertz wasn't born back in 1744. The point is to use a smooth approximation. So what does this look like? So the logarithm of the survival probability in a Gompertz Maycam model is going to look like this. What are you seeing on the screen? What are these equations? So you have three key parameters. You have lambda, which is the accidental death rate, the Maycam constant. You have m, the modal value of life, sort of the age at which people are most likely to die. And you have b, which is the dispersion. In the 21st century, we'd expect to see m values of 85 or 90, B of about 10, accidental death rates that are very low. We're talking about the 18th century, so the parameters were very different, but the functional form actually fits rather well. If we take a look at Edmund Halley's mortality table from 1693, which was used in the design of the plan, and I were to fit a Gompertz-Maycam curve to it, there's virtually indistinguishable. And the reason I need to tell you this is because I'm using a Gompertz-Maycam annuity pricing formula to see whether Adam Smith got a good deal or not. So here we go. An annuity for basic net single premium is this expression here. I will not go through it. When you have 2 lives, an annuity that pays for the longer of 2 lives, obviously the probability of survival is now as long as one of X and Y are alive. This is going to be the annuity. The survival probabilities are obviously the odds that both of them have not died. So it's 1 minus the probability that both of them are died. And the key insight here, and again, this is Actuarial Science 101, is that a reversionary annuity is the difference between an annuity that goes for the longer of 2 lives minus the annuity of the individual that's contributing. It takes a while, you stare at it and it's like, what? But eventually the light bulb goes on and you say, yes, of course, the annuity continues for the second life, but not for the life of the first. And then the multiple that I've been talking about, the 3.81, is simply taking the annuity that the person pays until they die, right? Because they have to make contributions until they die, and dividing it by the net single premium that would result if they were buying a reversionary annuity lump sum. Okay, what does all of this mathematics lead to? So here we go. What should the numbers be? They were 3.81, and that's what everybody had to pay. What should they be? I'm going to use a 4% interest rate because that was the plan's assumed return. Actuaries have an assumed return for the plan, and the actuaries that designed this plan assumed a 4% rate. How did they get that 4% rate? Were they discounting at the expected rate of return from assets, which is very controversial? No, they did something even more clever. They forced every participant to take out a loan from the plan at 4% interest. What a brilliant way to ensure that the fund earns its target rate of return. Force everyone to borrow from the plan at 4%. And when they already gave everybody forced loans, or I don't know if I'd use the word forced, but when they induced everyone to borrow, they went out and they shopped around for rates at a minimum of 4%. So what should the multiple be? So here we go. You know that the age of the spouse is going to be important. The younger the spouse is, the less likely they are to die, the more generous a multiple you can give. Also, the age of the contributor is going to be important. So here we go. If you are 30, you're the contributor. Remember, Adam Smith's 28, and the spouse is 30. What should the multiple be? You should be getting 4.55. You should be getting more than 3.8. You're young, you're going to be making contributions for a long time. Your spouse is young, she's not going to be passing away for a long time. Then you should be getting 4.55. That's the fair actuarial multiple. If you're 35 and your spouse is 30, well, you should be getting a slightly lower multiple. Why? Well, you're not going to be contributing for that long. If your spouse is 35, it's about 4.3. You see where this is going as we fill these numbers in. I'll give you a second to take a look at this. I'll draw your attention to the lower parts of this table. How do you read this? If you are 65 years old, you're 65 years old, and your spouse is 30, and this did happen, you should be getting a multiple greater than 1. It should be less than 1. You're going to pass away very soon. You're not going to be paying premiums for very long. Even if she's 30, you should be getting a multiple that's going to be, a lower multiple. Slightly higher multiple, we see at higher ages, but this is what this table looks like, and compare it to the 3.8 that we saw earlier. So older people got a good deal. Young people got a bad deal, but here is the punchline. Smith never married. He never married over his entire life. He paid these contributions for when he was a professor at Glasgow. He started at the age of 28. He was there for about 10 years until he went to Europe. Different story. He resigned his tenure. And was this a good investment for him? Well, certainly ex ante, maybe he didn't know that he wasn't going to get married, but he was young, so he was contributing a little bit more than he should have. The multiple should have been higher. And of course, ex post, he never married, so the payout, there was no payout to a widow. Adam Smith never wrote about this in either Theory of Moral Sentiments or Wealth of Nations, and his biographies do not mention his participation in this scheme. Could be that his biographers just don't think this is important. I stumbled on his name in the archives. I did not know. I was looking at the scheme for different reasons, and I stumbled on his name there, and I said, wow, I wonder if anybody knows this. So far, nobody's come to tell me, yeah, we knew this. We knew he was a member of the scheme, although by default, if he's a professor in the 1750s, he should have been. But he made some references to the scheme, and this is where I find it interesting. He made a reference in The Wealth of Nations. He was talking about trade unions and monopolies and collusions. He didn't like trade unions. He was anti-union. He felt that people from the same industry shouldn't even gather together to talk because they're going to collude. So you don't want to get people together. But he made an exception, and he said, here's an exception. A regulation which enables those of the same trade to tax themselves to provide for widows and orphans by giving a common interest to matter, that assembly is okay. You want to get together and talk about creating a fund for widows, that I'm going to allow. Interesting reference. He also wrote some letters that are not part of Wealth of Nations or Theory of Moral Sentiments, where he made some favorable comments about the Reverend Alexander Webster, who had helped create this, and he was pretty, favorable towards him, although not necessarily the fund. He didn't mention the fund itself. In conclusion, I am done. Why is this relevant in 2023? Why should someone care about a fund that existed hundreds of years ago and the choices that participants made in this fund? Well, if you're a fan of the Scottish Enlightenment, and if you study the Scottish Enlightenment, and you're interested in Adam Ferguson and William Robertson and some of the famous Scottish Enlightenment personalities, they all made choices. Some of them said, I want in, some of them said, I want out. But if you're a pension specialist, why would you care? I would say that debates around choice architecture, default options, auto-enrollment, anti-selection, older people selecting better benefits. And they knew that. They knew that older people were selecting better. This infuses the pension and insurance literature, especially recently with discussion of default options on annuities, were prevalent in the mid-18th. All of these discussions were taking place. The terminology that we're using was different. They didn't use the word nudge. That didn't exist. But they talked about, well, what we're going to do is we're going to put people into this one if they do nothing, and we expect most people will do nothing. No, they actually said, no, I'm not interested in that fund. You want to learn more about this, you can read the paper. Where is this paper available? For those of you that are saying, hey, I want to read more. So a draft of this paper is available on SSRN, Adam Smith's Reversionary Annuity. This is a draft. A final version of this paper is going to be forthcoming very soon. It's been accepted for publication on the Financial History Review. So that is where you can find the paper. Thank you very much. I'll take questions at this point. But before I do that, I will ask people to guess. So let's see who can tell me where this is. Where is this location? I will now stop my screen share and open it up for questions.
Terrific. Thank you very much, Moshe. That was really interesting, and we've got lots of comments in the chat that people have found this really, really interesting. So thank you very much.